Good afternoon, this is Sean Golding with Golding & Golding, here to discuss the basics of Form 1040 Schedule B and its impact on reporting foreign accounts, interest, and dividends. The Schedule B is essentially the gateway form into offshore compliance, right? It doesn't get into the specifics of the accounts like other forms such as the FBAR and the 8938, but it's a very important form, one, because it's used to identify dividends and interest, whether U.S. sourced or foreign sourced, and B, it requires the taxpayer to indicate whether they have a foreign account, whether they have ownership or signature authority, and if they're required to file the FBAR. For some reason, there is a massive amount of fear-mongering online. You mess this form up, that's the end of your life. It's nothing like that. And there are some cases out there that you read about, Manafort and things like that. Yeah, I mean, if you put no on Schedule B and you're out there creating offshore companies around the world, generating millions in income and not reporting it, yeah, it's a problem, right? But it's not because the only reason why was because he accidentally, let's say, put no for Schedule B. So let's kind of walk through here. The Schedule B is used when a person has interest or dividends. It doesn't matter if it's U.S., it doesn't matter if it's foreign. When a person has dividends and interest reportable on the tax return, right, they file a Schedule B. If generally there's a $1,500 threshold, okay? So for many people that don't meet the threshold, they don't think that they ever have to file the Schedule B. In fact, most software programs may not even ping you to file it, okay? But when that same person has foreign accounts that they own or have signature authority of, even if they don't have to file the FBAR, they still have to include the Schedule B. The top part of the Schedule B refers to interest and then dividends, and then there's a bottom section of the Schedule B. And basically what it asks is it wants to know three very important things. One, does the person have ownership or signature authority over a foreign account, where those accounts are, and whether the value exceeds the value necessary for the person to have to file the FBAR. In other words, does the person have ownership or signature authority over a foreign account? If so, in what country or countries? And is that person required to file an FBAR? There's another question about 3520 foreign trust, but that's beyond the scope of this presentation. So if you put yes for either one of those, then the form is going to be generated even if your interest and dividends is below otherwise the threshold requirement for having to file a Schedule B for someone, let's say, who only had US-based interest and dividends. It gets confusing, Schedule B, for a lot of taxpayers, especially those who have income overseas, because in a lot of different countries, passive income such as interest and dividends isn't taxable. It's not reportable. So a lot of times someone will come here, they'll start filing tax returns and think, well, I'm not going to file it because I don't have to file it there. It's not taxable overseas. From a U.S. perspective, it doesn't matter. You include all the interest and dividends. If it's tax exempt in the U.S., then there's a portion on the 1040 where you identify how much tax exempt interest that you have. But the mere fact that it's tax exempt overseas doesn't mean it's tax exempt here. If it's a treaty country, you go through the treaty and see if there's any exceptions, exclusions, or limitations. If you paid tax overseas on the income already, then generally you'll be able to claim what's called a foreign tax credit for the income that you already pay tax on overseas. Just because you pay tax overseas doesn't mean that you're not going to have to pay tax here or that it's not reportable here. And it's important to do the gross. So let me give you an example. Let's say you had $1,000 overseas and you paid $200 in foreign tax, okay? Some people will just say, well, I'm just going to report the $800 here, right? The net effective. But that's not the way to do it. You would report the $1,000 and then you report the $200 in separate tax. Here's why. Let's say that you have $1,000 of income and your tax liability would be $200 in the U.S. based on your progressive tax rate. Well, then that $200 foreign tax credit may very well offset the $200 that you would have to pay here on the income. Conversely, if you just report $800 as income, you're going to get taxed on it again. So that's why it's important you claim the gross and then you claim the credit. willful versus non-willful, Schedule B, offshore compliance, and all that jazz, right? So if you didn't know about the form, you didn't know there was anything you had to do, and you never filed it, that doesn't make you willful, okay? If you filed the form and you put no, because that's what the computer generated and you just didn't look at it, you didn't think twice about it, that doesn't necessarily mean you're willful either. Yes, taxpayers have a requirement to review the form before they sign it, yada, yada, yada. The courts have said that, but it's all based on the totality of the circumstances. So you have to look at all the facts and circumstances that go with the mistake. Is it, Dean, who's been in the country for 1 year as a permanent resident, had the account, it didn't generate any income, he didn't know he had to file it, didn't know he had to report income that he's earning overseas, maybe didn't earn any income overseas, so he thought he didn't have to do the Schedule B, maybe he paid tax over there and misunderstood that you still have to report it here and apply the tax credits, right? That's going to be different than Peter, who has 15 foreign bank accounts, right? A whole bunch of different holding companies in different countries. He's got a number account in Switzerland. He's got a few Panamanian companies. He's got a Belize Corp. And he knows he's supposed to put yes because he knows he's supposed to file Schedule B, but he puts no. That's different, of course, right? So you have to look at the totality of the circumstance. The mere fact that you may not have marked yes when you had foreign accounts absolutely 100% does not mean per se that you're willful. If you're out of compliance, there's lots of programs you can use to get into compliance. We have lots of videos available on the different ones. There's voluntary disclosure program for those of you who are willful. There's the streamlined domestic offshore procedures for U.S.-based taxpayers or just those that don't qualify as foreign residents. It's a very specific rule. Streamlined foreign offshore procedures for those of you who do qualify as foreign residents. It's probably the best program out of all of them because you could file original returns as well as zero penalty. By the time you factor in things like foreign tax credits and foreign earned income exclusion, you may not owe anything to the government for years of non-compliance. There's also reasonable cause and delinquency, the delinquent international information return submission procedures, long sentence. They got rid of, they didn't get rid of it, but they modified it in November of last year, 2020, so that it's basically just like making a reasonable cause statement. We have lots of free information available on our websites. You can always reach out and schedule a reduced fee initial consultation if you think it's appropriate. Again, my name is Sean Golding with Golding & Golding. Thank you for your time. Enjoy the rest of your day.